Good afternoon. This is Howard Sorkin, DePaul University, in the 116 web-based capstone case study course. This is Chapter 4, the overview of income tax planning. Now, please be aware of the fact that if you're helping people with their taxes, make sure that you understand what your liability is and make sure that the individuals are relying on their own tax advisors, CPAs, or if they have a high net worth, even possibly their attorneys that specialize in taxation. Please remember that the purpose of tax planning is usually to reduce tax liability today and into the future, and to establish a foundation for planning to help them accomplish their goals and objectives. And from your perspective, it might be more of an educational exercise because you may want to have the caveat that you're just making recommendations, again, unless you are a tax preparer, a CPA, or an enrolled agent. It says on slide 6, review the basic steps to analyze and evaluate the client's tax situation. Remember to take into consideration the income tax, their state income tax. You may be called upon for both gift tax suggestions as well as the suggestions for legacy planning or estate tax. And please remember that just because the federal estate tax level is at one situation doesn't mean that it always carries through at every situation for every state. The state of Illinois is at a $4 million threshold where the federal government is over $5.25 million. Slide number 7. It says for basic steps, what's their gross income? Step 2, exclude non-taxable income. Calculate their adjusted gross income. Subtract expenses. And go on. And remember that if they're high earners today, they may have the extra success tax for Social Security and Medicare planning. Many people forget, and many people don't understand, that you continue to pay taxes on Medicare over the threshold for FICA or Social Security. It says review the current tax situation and start by evaluating the client's situational factors related to their planning. You need to understand what their ideas are about tax planning. You need to understand their values, their beliefs. And I will tell you, I've had clients who have said to me, anything that will, short of going to jail, I'm willing to do to avoid taxes. You have to be very careful about that because it's a very fine line between short of going to jail and really getting too aggressive or pushing the envelope. So remember that sometimes pushing the envelope will open the client up to audits, and then you're going to get blamed, especially if you're not a tax preparer. And if you're a financial planner, a financial advisor, an insurance broker, your errors and omission insurance will usually not cover you for tax planning. Tax recommendations need to take into account the social, moral, and religious perspectives of the client. Even if you do not necessarily agree, you're not there to make value judgments. Donating a standard percentage of income to a religious, charitable, or social organization may or may not provide the optimal cash flow and tax credits and savings, but in many cases the choice is driven by a client's personal situation and their personal factors that are important to them. What do we have to figure out in order to do this? We have to gather data. And sometimes you have to look at previous tax returns and remember for the comprehensive exam, the optimal number of tax returns to be looking at would be 3 years. And sometimes you have to be looking at their employment history, their number of dependents. Are they going to be increasing or decreasing? Do they get refunds? Do they want refunds? Are they able to put money away every year for tax purposes into a retirement account? Slide number 11. It says 2 alternatives exist if a plan is being written after the client has filed a tax return. Review the most recently filed returns and see what they've done that's correct. But if you're not a tax preparer, get someone that understands how to do that to work with you so you're not taking liability you don't understand. As a financial planner, you're supposed to have a general broad idea about taxes, tax preparation, ordinary income tax, capital gains tax, the success tax now for Medicare planning, the thresholds for Medicare and FICA and where they're at, Be aware of the fact that these thresholds for Roth IRAs and different college funding programs and deductible IRAs are frequently tested, the thresholds. Remember that income is not restricted to salaries. It could be pension income, rent and royalties, dividends, capital gains, even has gambling winnings or hobby income. What does Section 79 mean? What kind of income is that? Make sure you understand what Section 79 means in terms of employee benefits. Does your client frequently get tips? Is that part of their normal income? If they are in a business such as waiter, waitress, beautician, or so forth, they may be getting tips, and you better know how to handle it. Remember about capital gains and how to manage tax losses. What do capital gains really mean? The difference between passive income and active income. And it says only $3,000 in net capital losses can be used in any year to reduce taxable income. While excess losses may be carried forward, it's important for you to remember that losses needs gains to offset them. So if you're harvesting losses, please make sure you understand what you're doing. And for some reason, I just lost the slides here. Give me a second, please. I don't know what just happened, but we have to figure out how to get back here. I'm on slide number 13, I think. Slide 14 talks about hobbies. Some clients may engage in activities that are difficult to distinguish between a hobby and a business, such as training horses, racing cars, writing books. And better keep good records and tell your client to keep good records, because the IRS is going to ask, are you running a business or is this a hobby? And someone who has a substantial outside income that tries to claim a hobby activity as a business expense may be denied deductions. And be aware of the fact that there's two-tier deductions and that 2% of AGI on Schedule A. These are things you have to be aware of. The alternative minimum tax, slide number 15. Originally, this was supposed to be for high-income earners and people that were making sure they paid a minimum tax. However, it was never indexed for inflation, so now a lot of people are paying AMT tax that are not making hundreds of thousands of dollars. In fact, they only be making $68,000. Congress created the AMT to prevent wealthy taxpayers from taking advantage of a lot of preferential deductions. However, a lot of common people are now being charged the alternative minimum tax, and they don't understand why. Again, if you're not a tax preparer, refer them back to their tax preparer. Taxpayers reporting substantial preference items in any given year may trigger AMT, and that AMT will usually be a higher tax percentage than what they're currently paying. Make sure you understand what the graduated income tax law means. That doesn't mean you're always paying at the 38 or 39% level. It only means you're paying income tax at that federal tax level on the income earned above that number. It says figure out the client's tax liability, and there are calculators and CPAs will do that. Again, if you're not a tax preparer, understand for the exam what you need to understand, but be aware of the fact that you may want to defer to their tax advisor in order to get them the information that they need. You may need to identify different products and strategies to minimize taxes. You may need to determine whether municipal bonds and or deferred income strategies are important. You must be able to figure out what the after-tax rate of return is on an investment. And here it's saying, using this formula, a client in a 25% marginal tax bracket earning 4% on a municipal bond would need to earn at least 5.33% of the equivalent. This is something that might be tested, but it's something you really need to understand. That if someone is investing in municipal bonds, what is that equivalent rate to in the event that they're in a non-municipal or vice versa? This is something that will be tested. Other tax planning items that should be documented and evaluated prior to making planning recommendations include triggering AMT, contribution levels to employer-provided benefit programs, allocation to pre-tax plans, and whether people should take and sell investments now as opposed to later. Slide 20 and 21 is out of your textbook. I'm not going to go through it. Slide 22, the number of different planning products and solutions that can be found on chart 4+3. Do you want to convert taxable interest to tax-exempt interest? Do you want to take advantage of tax advantageous debt, which would be a mortgage or home equity loan? Are you going to talk about paying the tax up front and using a Roth IRA or a Roth 401k and never being taxed again and never having to worry about it required minimum distribution? Or do you want to stay in a traditional product? Do you fully understand the tax ramifications and planning benefits of 529 plans, uniform gift, and trust to minor accounts for college, and how they work not just for income tax, but also for gift and estate tax? Make sure you're familiar with it. Make sure you're familiar with the phase-outs for the Roth IRAs and so forth. You may have to help clients determine whether they're going to match their withholding to what their long-term tax goals are and whether they want refunds. Are you going to shift expenses from one year to another? How are you going to maximize capital gains? Make sure you get the appropriate data and do a good job of getting it. And I frequently will refer back to the client's accountant and let them make certain decisions. I want to work with the accountant. I don't want to make the accountant an enemy. What does taxable income mean? Well, you know what? We've already done that. I don't know why all of a sudden it went backwards, not forward. Sorry. Okay, I did this slide. I'm now at slide 26. How many deductions and dependents are you allowed to deduct and take advantage of? Remember, like-kind exchange strategies are appropriate for certain people, Section 1031. Understand the implications regarding unrealized gains and losses. Compare taxable versus non-taxable returns. When should you itemize? When don't you itemize? Does everyone make sense to itemize? Not always. Pay attention to the changes in the tax laws. And they're always talking about things for paying taxes. The equivalent taxable rate of return. The equivalent taxable rate of return, I'm on slide 28. Tax rate minus the free rate of return divided by the marginal tax bracket. Deductibility. Remember, for the most part, you have mortgage deduction on the first $1 million. Home equity debt interest is deductible only if the loan is the lesser of $100,000 or the fair market value of the home. That's the first mortgage. And be aware of what people may or may not be able to do for a second mortgage. I'm over on slide number 33. Qualifying as a dependent. Be aware that you understand the 5 steps to qualify as a dependent. You must live with the taxpayer for the entire year, be a member of the household, or be related. You must be a U.S. citizen, U.S. national, or a resident of Canada or Mexico. The person must not file a joint return on their own. The person's income must not be equal to or exceed the exemption. The taxpayer must generally provide at least 50% of all of the expenses in support during the calendar year. Never assume past returns were accurately prepared. Many times, especially you're dealing with a new client, the advisor will rerun the previous year or two's taxes to make sure that they're done properly. This is an overview of the Chapter 4 tax planning. Using the 1040 form as a planning tool, there's all kinds of information. I'm referring to slide number 35 or 35, and where you can look for data to make sure that they're taking the deductions and the benefits they want. Thank you very much for listening. We will finish at another time chapters 11, 12, and 13, so that you will have been able to, on your own, listen to the entire textbook. This is Howard Sorkin for DePaul University. Thank you very much.